Hi, and welcome to Behind the Data with me, Glen Pereira. Today we're diving into key factors shaping the energy market since our last update at the end of May. Our top three drivers behind the prices for June have been geopolitics, French nuclear, and liquefied natural gas, also known as LNG. Before the volatility took hold, June saw 3 consecutive days of losses, with the market dropping over 8% in value. At the time, stable fundamentals and relative quiet geopolitics backdrop had the market gearing up for further declines. But the calm didn't last. But just as it looked like prices were heading lower, the mood flipped. As a sudden change in sentiment sent the market sharply higher. Here's what drove the turnaround. The first major driver is geopolitics. Rising tensions between Israel and Iran have shaken up the market and pushed prices higher. Escalation started on 12th of June when Israel launched a surprise attack on Iranian targets that immediately sparked concerns about a wider conflict in the region. And Brent crude, which has been trading under $70 a barrel, climbed steadily over 81 by June 23rd, after the US struck Iranian nuclear facilities. The reaction just wasn't in oil. Gas and power markets jumped even more. UK gas prices for forward month surged nearly 18%, and power climbed about 15%. Meanwhile, LNG shipping costs hit the highest levels in 8 months, as more tankers were rerouted to Asia and supply from the Middle East tightened, especially with the US zeroing on Iran's nuclear sites. Markets movement at this point reflected a clear anticipation of further conflict, and the risk of escalation was clearly priced in. There were growing fears that Iran might try to block Strait of Hormuz, a crucial shipping lane that handles about a fifth of world's oil and gas flows. Iran's government even voted to close the route, but despite the threat, supply kept flowing without interruption. Then just as quickly as things heated up, it began to de-escalate. Iran's response was more symbolic than a limited missile strike on a US base in Qatar that caused minimal damage, and later the US president announced what he called a complete and total ceasefire between Israel and Iran. Market took notice right away. Oil, gas, and power prices all reversed sharply, falling below where they were before 12th June. Looking at a second driver, which is French nuclear. Reports of stress corrosion identified at EDF's 1.5 gigawatt Civaux 2 nuclear reactor. Right now is just one unit, but the market clearly has concerns about what might come next. If inspections uncover similar problems elsewhere in the fleet, we could be looking at broader shutdown, and that is a big deal, especially with crucial pre-winter hedging season just around the corner. This is not the first time EDF has faced this. Back in 2022 and 2023, stress corrosion forced a big chunk of their nuclear fleet offline, causing power prices across Europe to spike. That memory still lingers with traders. That said, EDF has since said that corrosion has been confirmed at Civaux 2. They don't expect the overall nuclear output to be impacted. While the development provided some reassurance to the market, sentiment remains cautious. Any further findings could swiftly reignite the concerns. Ultimately, the bearish news was largely overshadowed by the escalating geopolitical tensions between Israel and Iran, which kept driving prices higher and fueled the broader rally. Our third and final driver is LNG. We have seen some recent disruption to supply from the US. First, the Cameron LNG plant, which was operating below capacity from early May through to mid-June, is now picking up again and getting close to its usual output. Meanwhile, Sabine Pass, another major terminal, was also running at reduced capacity during its maintenance window for most of June, but that too is showing signs of returning to normal. On top of that, we had a major policy development from the European Commission. They have proposed legally binding measures to completely phase out Russian gas and LNG imports by the end of 2027, a major move that would break long-standing energy ties with Russia. Starting January 2026, the EU will ban any new contracts for Russian LNG. Then from June 2026, even short-term deals signed before mid-2025 will be blocked. The biggest change comes in January 2028, where all existing long-term contracts, including those with companies like Total Energies and Naturgy, must be terminated. LNG terminals across Europe will be affected, with the new Russian service deals banned from 2026 and all its existing contracts ending by 2028. Since around 2/3 of European Russian gas imports are tied to long-term contracts, this makes a significant structural shift for the market, one that adds sense of tightening supply and ongoing volatility in the global energy flows. As we enter July, there are two main drivers that will affect the gas and power prices. First one is tariffs, as the deadline to close the deal is nearing. Any deals concluded could support the prices, as it is expected to improve the economic outlook. And the final driver to watch out for is the rising river temperatures in France, which could disrupt output from French nuclear, hence decreasing the overall supply through interconnectors. These two drivers could drive energy prices higher. Thank you for your time, and I hope you found this update useful.